Welcome to Study Loop.
Okay, here we have a problem, supply and demand. So this is the quantity, this is the price, and this is the supply line, this is the demand line. So in this situation, this is the market equilibrium, right? This is going to be this point is equilibrium point. This is equilibrium quantity, and this is equilibrium price. But now you have the government coming in and putting a floor for the price, right? If you put the floor below the equilibrium price, that would not be relevant, that would not be effective. So when they put the floor, that means it's above the equilibrium price, right? So this is the price floor above equilibrium price. And you see what happens here, that at this price, this is the amount that is demanded, and this is the amount that is supplied by the supplier, right? So this is Q demand, this is Q supply, and as you see, at this price, there is going to be more supply in the market than there is demand. So there is this much surplus, right? There's this much surplus. And so that's the first question. It's going to cause a surplus in the market. The other question is that the producers complain that the revenue has dropped, right? Because now the revenue is going to be, the original revenue was this area, the red area, okay? But then the new revenue after the floor is again quantity times price, right? Quantity sold times price. This is quantity supplied, but this is not going to be sold necessarily. This is the quantity which is sold, and QD times the PF, price of the floor. So you are going to have this area, the green area, right? And the green area could be less than the red area, and that causes the revenue to drop. Even though the price has increased, but the revenue might drop, okay? And it can have something to do with the elasticity of this product. And now the third assumption is the government actually comes in and buys the surplus. And so this